Good afternoon, traders. I'm Himali Bhatia from the Financial Analyst, and I welcome you to the Bold Project. In this module, we were discussing about the Dow theory, and in the previous episode, we discussed why Dow theory is important for us, what is the motive behind us understanding the Dow theory, and we also understood the first principle of Dow theory, that is, why the stock market discounts all information. All right. Now, in continuation to this, we will be now covering the second principle known as the stock market has three trends. All right. Let's place a little bit of more light on what does this mean. So, stock market is made up of three trends. So, what are the three trends? First being a primary trend, second being a secondary trend, and third being the minor trend. Now, in this episode, we will be discussing about the primary trend first. Now, what the theory suggests is that a trader should always place a lot of focus on the primary trend, and he should always trade in the direction of the primary trend. The reason being, this trend will never ditch a trader in a volatile situation. So let's take a look at the chart and try to understand what is our primary trend over here. So I have opened up HDFC Bank 1 month chart, and through a trend line tool, we will be understanding what our primary trend is. So the primary trend for HDFC Bank 1 month chart is this. All right. Now, just looking at the chart, it is pretty evident, and using, of course, the trend line tool, it is pretty evident that the stock is in an uptrend, right? The stock is moving on the upside, and the prices have ever increased. However, what happens is once we decrease the time frame, it becomes very difficult for a trader to determine where the primary trend is. So let me give you an example. Let's open up the 1 day chart. Now, on the 1 day chart, also, if I try to place a trend line, I can do it and I can find out the primary trend over here. What will my primary trend be? From this period to this period is currently my primary trend. Now, let's do one thing. Let's reduce the time frame even further. Let's go on to the 15-minute charts. Now, what is happening? Now, it becomes very difficult for a trader to determine where the primary trend is. Just because of the volatility, it is very uncertain where the primary trend is. Does it want to go up or does it want to come down? What is the picture exactly representing? So, in such cases, what we do is let's go back to the day charts. And in such cases, what we will do is we will put in an indicator known as the moving average. All right. So the indicators tab is over here. Click on it and search for something known as the moving average. Now, by default, the moving average will capture a 9 period. What is moving average? Let me cover this in short. Moving average is nothing but taking the average of the close price of the past 9 candles. Why 9 candles? Because by default it is capturing a 9 period. Why do we say it as a period? Because it is specific to the time period that we select. Now, since it is a day chart, so it is taking an average of the close price of the past 9 candles. All right. Now, instead of a 9 period, what I will wish for is a 200 period because it shows us the biggest picture in the market. So now once I place a 200 period moving average, what will I see? I will see that if the green and red bars in this case, which are known as candles, which will be covered in the next module, if you see that these candles are above the blue line, that is, the blue line is indicating your moving average indicator, and if the candles are above your indicator, that means the stock is in an uptrend. That means the prices are moving on the upside. However, if the stock or the candles are moving below the 200 period moving average, then we say that the stock is in a downtrend. All right, so the charts had effectively captured the COVID situation. It was asking us to stay on the short side, and from here, the prices has plunged a lot. So let's use this on a 15-minute charts as well to get a better picture. Again, on the 15-minute chart, what is happening is the candlesticks are above the indicator, the 200 period moving average indicator. That means the candlesticks or the stock currently is in an uptrend. But do we buy immediately? No. This is not a buying signal. This is just showing us the trend of the market. This is not giving us the entry point, neither it is giving us the exit point. Entry exit points will be determined in the coming modules. But for now, you need to understand that this is just showing us the direction of the market. Does the market want to go up or does the market want to go down? Clear? Now, there is one small glitch with investing.com when you use this indicator, the 200 period moving average indicator, is that it loads very slowly. If you have to backtest a strategy, it loads very slowly, and thus what you can use is you can use the TradingView website. That is far much better to use such indicators. All right. So let's take a few more examples. Let's take Reliance and see what is the trend over there. We move on to the day chart. Now, beat any stock, we will be using the 200 period moving average only. Now, again, the candlesticks are above the 200 period moving average. That means this stock is currently in an uptrend direction. If let's try to take one more stock, maybe Future Retail might be having a situation which is showing you a bearish trend or a downtrend. Perfect. So in this case, in case of a Future Retail, what is happening is the candlesticks are moving below the 200 period moving average. That means it is clearly indicating that this stock is currently in a downwards direction or a downtrend. All right. So let's take a few examples. Uh, let's try to understand this figure first. Now, what is this figure representing? It is showing us an uptrend, right? But one thing that we need to understand over here is the market structure. What does a market structure mean? Market structures can be of three types. One, that there can be an uptrend in the market. Second, there can be a downtrend in the market. And third, the market can be in a sideways direction. So now what we will do is we will try to determine if the market is in an uptrend or a downtrend or is it in a sideways market, which is also known as consolidation. So in this figure, what we have is we have point F, D and B, which are at the top of the trend. And these are known as the highs of the market. Similarly, the point G, E and C are known as the lows of the market because they are found at the bottom of the trend. Now, if I analyze this figure even further, what I will see is that point F is higher than point D and point D is higher than point B. That means the market is making higher highs. Also, if I look at the lows, the same pattern is being repeated. G is higher than E and E is higher than C. That means the market is making higher lows as well. So if I put this in a statement, I will say that the market is now making higher highs and higher lows. And if I give the statement a market term, this is nothing but your bullish trend in the market. Similarly, let's take a look at this figure over here. When your market is making lower highs, now why do I say lower highs? We have the point G, E and C over here, which are known as the highs, correct? Again, we have point F, D and B, which are known as the lows of the market. Now what is happening is point G is lower than point E and point E is lower than point C. That is why I had said that the market is making lower highs. What about the lows? Again, at the lows, what is happening is point F is lower than point D and point D is lower than point B. That means the market is making lower lows as well. So if I put this in a statement, I will say that the market is now making a structure of lower highs and lower lows. And if I give this a market term, I will say that this is nothing but your bearish trend. All right. Now, why is this very important to us? Because what happens in a market is market never moves in a straight line direction. It always moves in a wave-like manner, be it in an uptrend or be it in a downtrend. Now, what happens is traders often get confused. Let's say the traders are at this point over here. They now think that the market has started a downtrend from here and they start selling the stock, or in other terms, they start shorting the stock, which is not the right approach to the markets. We always have to check where the next high is, where the next low is, and then determine if the trend is in continuation or not. So let's say that there was an uptrend in the market where the market was creating higher highs and higher lows. And when will we consider this to be a reversal in the market? When the market creating lower highs and lower lows, then we will say that now the market has reversed, and in this case we will be selling the stock or we will be shorting the stock. All right, let's take some live examples. Let's open up Tata Motors. Now, these all analysis can be applied on any given stock. It does not really matter. Now, over here, it is pretty evident that the market is creating a higher high, higher low structure. How? We can see that these are higher highs and we have the higher lows. Again, we have the highs and we have the higher lows. So the market is creating a higher high, higher low structure. That is why we say that the market is in an uptrend. Now, what has happened after that? Immediately after that, we see that the market had made a lower high followed by a lower low. Again, it made a lower high, but this time it did not make a lower low, rather, it made a higher low. And thus, the bearish trend did not, we wouldn't say that there is a reversal in the market. We have to wait for this second time confirmation. And from here, you can see again the prices started moving on the upside. That is why the market structure of higher high, higher low for a bullish trend or lower high, lower low for a bearish trend is very important. Let us take one more example. Let us take Cipla. All right. Again, what is happening over here is the market is making a higher high, higher low structure. How? This is the high of the market. This is the low of the market. The next high is higher than its previous high, and the next low is also higher than its previous low. Again, we look at the next high. The next high is higher than its previous high. The next low is again higher than its previous low. So on and so forth, this trend is continuing. Now what has happened is the highs in the current market is range bound. That is, the market is consolidating or it is rather in a sideways market. Now, why do I say that? Because the highs are at an equal level, so are your lows also at an equal level. So it is currently range bound, and thus we say that the markets are consolidating. Now, if you ask me, why aren't we considering this period over here where the candle has gone below the previous low? This will be covered in a support resistance lecture, and there you will understand that we always consider a zone and never a particular level. So that will be covered over there. And for now, you need to understand that this is in a consolidated market. Clear? Again, this you might ask that why it is creating a lower high and still you're considering in a consolidated market. The reason being, again, the same thing, it will be covered in a support resistance lecture, and we always consider a zone over here. That is why I would not consider this as a lower high. I would rather consider this to be an equal to its previous highs. I hope this clears your doubt. All right. Now, we will cover the secondary and the minor trend in the next episode. If you have any questions, Please note it down. We will be covering it in your live doubt clearing sessions. I hope you enjoyed this lecture and I hope to see you in the next lecture soon.